US stock market crash is accelerating at a breathtaking speed, and a 1,000-point flash wipeout indicates that the beginning of a historic financial nightmare is already here. Is this the big one? Wall Street is asking. Last week, the stock market has faced extensive losses, and investors are worried about what will happen when markets open this week, as fears of a massive drag down in the S&P 500 continue to rise. But before moving on to today's discussion and sharing some critical info about the market's doom and gloom, please don't forget to leave a thumbs up and please subscribe to our channel so you don't miss our upcoming videos. On Wednesday, the Federal Reserve might have started to realize that it has made a colossal policy mistake over the past decade. As its benchmark interest rate rose by 50 basis points to help fight soaring inflation, Wall Street investors went into full panic mode. The largest single-day stock market crash ever recorded occurred on Thursday, at a time when stock prices had already fallen quite dramatically. Since the start of 2022, several stocks have been hammered, and many have not recovered ever since they've started going down. In fact, we've witnessed the worst start to a year for stocks in decades, and many signs are suggesting that this is the beginning of a truly historic stock market collapse, with trillions of dollars still on the line. Investors know that you only make money in the stock market if you get out in time. Holding stocks when they're hitting all-time highs is not the only important move. Knowing when to sell is what is going to determine whether you're going to make a profit or bear the losses. Needless to say, markets tend to go down much faster than they go up, and a significant shift in investor sentiment is now unfolding right before our eyes. On Thursday, all the major indexes faced a brutal shock. The Dow Jones Industrial Average lost 1,063 points, or 3.12%, to close at 32,997.97. The S&P 500 fell 3.56% to 4,146.87, marking its second worst day of the year. And the tech-heavy Nasdaq Composite got absolutely crushed, falling 4.99% to finish at 12,317.69, marking its lowest closing level since November 2020. These losses were the worst single-day drops since 2020. Days before the flash crash, stocks were melting up, an expression used to describe the moment when indexes are trending lower, but some bubble stocks are still being propped higher as speculators anticipate further losses. On Wednesday, all the indexes recorded strong gains, only to lose all of them and some more over the next trading session. If you go up 3% and then you give up 0.5% the next day, that's pretty normal stuff, but having the kind of day we had on Wednesday, then seeing it 100% reversed within half a day is just truly extraordinary. The words of Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. Tech stocks have once again been the main catalyst of the Nasdaq drop. Tech companies have been under extreme pressure as shares seemingly entered a free fall mode. Facebook parent Meta Platforms and Amazon plummeted 6.8% and 7.6% respectively. Microsoft fell 4.4%. Salesforce sank 7.1%. Apple dropped 5.6%. But the losses faced by some e-commerce names were even worse. Etsy and eBay tumbled 16.8% and 11.7% respectively after issuing weaker than expected revenue guidance. Shopify plunged nearly 15% after missing estimates on the top and bottom lines. I expected some sell-off, but the great puking that's happened I didn't expect, highlighted Kim Forrest, the founder and chief investment officer at Bouquet Capital Partners. Is this capitulation? I remember what capitulation feels like. This kind of feels like capitulation when everything, even the good names, are getting barfed out. In contrast, for Morning Porridge's Bill Blaine, given the current outlook, the wipeout was already expected. In a recent analysis, the market strategist at Shard Capital said he's not surprised by the collapse of this overhyped market. We've all known markets that have been struggling for months. Sentiment is precarious. Momentum has been flat. We've been waiting for positive signals to resume the upside, but instead a host of exogenous and endogenous shocks from Ukraine, energy and food inflation, rate hikes, QT, tax rises, and politics have roiled sentiment. Even Robinhood traders can understand that people have lower real earnings and savings are stretched, then they won't consume as much and therefore the economy will slow, he wrote. The trigger that prompted investors to rush for the exits was the simple realization that the Fed will not back down from its tightening plan. It's going to be incredibly difficult for the Fed to normalize interest rates without having a negative impact on growth and earnings, added Paul Nault, portfolio manager at Kingsview Investment Management. So stock prices are too high if we're going to see a flattening or a decline in earnings per share. In Blaine's words, just as it happened during all good crashes, the actual trigger was fear. All of a sudden, investors are finding out that they don't know today's market all too well. Worse, they're noticing that corporate CEOs don't know what to do to hide the slower pace of growth and flatlining earnings. Crashes occur when the voting machine that is the market suddenly shifts and the maximum number of participants find themselves on the wrong side of the move. Often a trigger is needed, like yesterday's crash caused after the euphoric buy the fact rally was replaced by the realization that the Fed is indeed hawkish. That's a feature of all crashes. The folk we think know everything, the brilliant entrepreneurs, the leaders of the industry, the titans of finance, and mega-mind hedge fund managers are exposed as not knowing terribly much, Blaine notes. Given the extraordinary amount of leverage in the market right now, rapid declines can set off wave after wave of forced selling. In fact, if we look at the latest trends, this appears to be already taking place to a certain degree, and when stocks reach this point, there's no turning back. It'll certainly not take a lot of effort for this market slide to evolve into a market avalanche. A stock market crash is all about momentum, and when all indicators are showing negative results, it becomes a chain reaction. As the shift occurs, players worry less about chasing the market higher and start to question why it's falling. As they lack information, they wonder what others might know. Their core beliefs are shaken, concerns are magnified, sentiment is rocked, fear triggers selling pressure, causing the herd to stampede, and all these behavior shifts coalesce in a cascading ripple of panic that roils and rolls around the market, the strategist explained. The current stock market crash is happening because investors have been ignoring real risks and fooling themselves into thinking that the rally would not be stopped for way too long. But as Blaine illustrates, imagine a world where massive amounts of central bank liquidity have been juicing stock markets and keeping bond yields low for a decade, where financial assets have been trading at repeated record highs in spite of lethargic economic growth, where the global economy is racked by supply chain breakdowns, a global epidemic, out-of-control inflation, and increasing geopolitical tension and the threat of war. Imagine a world where one single automaker meeting a fraction of the world's auto demand is worth more and makes less than all the other manufacturers combined? Nothing about this seems reasonable. And yet this is where markets are at right now. So many things are simultaneously going wrong, and the outlook for the second half of the year is exceedingly bleak. We continue to get indicator after indicator showing that the United States economy is moving towards a recession. In fact, as stocks cratered on Thursday, we've also been told that in the first quarter, worker productivity has collapsed to the lowest point in over 7 decades. According to the Bureau of Labor Statistics, worker productivity fell to start 2022 at its fastest pace in 75 years. Non-farm productivity, that's a measure of output against hours worked, has also declined 7.5% from January through March, the biggest drop since the third quarter of 1947. The dire productivity data reflect the effects of the perfect storm of factors that converge to cause a 1.4% decline in the rate of economic growth as measured by gross domestic product. At the same time, we continue to get more bad news on the inflation front, with a new round of price increases being announced by several retailers, which will likely exacerbate consumers' woes in the coming months. All things considered, it is crystal clear that stocks can no longer stay at such inflated valuations. Over the past 2 years, we've seen lots of ups and downs happening on Wall Street, but this time, investors can feel that market conditions are different. According to Bank of America's chief investment strategist, Michael Hartnett, we're at the beginning of a bear market that will extend well into October, with the S&P at 3,000. Up until now, Hartnett's predictions have been proven right. A couple of weeks ago, he predicted that the S&P would fall to around 4,000 and that the Nasdaq would suffer its worst month since the Lehman bankruptcy. Hartnett also correctly warned that the closer we got to the 4,000 strange attractor level, the more aggressive the selling would become. The expert also compiled some useful information. Over the past 140 years, we have witnessed 9 bear markets with average price declines of 37.3%. The average duration of these declines was 289 days. Even though past performance is not always a guide to future performance, if it were, today's bear market would extend until October 19th, with the S&P 500 at 3,000, Nasdaq at 10,000, he wrote. Many sectors of the market are already there, he said, with 77% of stocks already in bear market territory across all indexes. Nearly 50% of Nasdaq stocks are below their 52-week highs, and almost 60% of stocks are at least 40% down. His gloomy predictions don't stop there. The strategist argues that the carnage is going to pick up speed as inflation hits 10% and growth nears zero. For a long time, stock prices were able to defy economic reality. Many of these bubbles certainly defied gravity, but now they're deflating, and as economic conditions rapidly deteriorate all around us, the party seems to be almost over. Everything is changing. Trillions of dollars are gone. But Wall Street is still failing to realize that what we have been through so far is just a warm-up act. The clock is ticking, and what happened on Thursday should be a major wake-up call for all of us to prepare for what's coming next. Thank you for watching. If you enjoyed this video, we strongly recommend 7-Year Apocalypse, the latest book by the economist and financial expert Michael Snyder. In the meantime, Feel free to share this message with your friends and family and turn the notification bell on to always keep updated with our latest notifications.